Good morning. Bank credit principles and practices. Bank credit constitutes one of the major sources of working capital for trade and industry. With the growth of banking institutions and the phenomenal rise in their deposit resources, their importance as the suppliers of working capital has significantly increased. Principles of bank lending. While granting loans and advances, commercial banks follow the three cardinal principles of lending. First one, principle of safety. The most important principle of lending is to ensure the safety of the funds lent. It means that the borrower repays the amount of the loan with interest as per the loan contract. The ability to repay the loan depends upon the borrower's capacity to pay as well as his willingness to repay. To ensure the former, that is, borrower's capacity, the banker depends upon his tangible assets and the viability of his business to earn profits. Borrower's willingness depends upon his honesty and character. Principle of liquidity. Banks mobilize funds through deposits which are repayable on demand or over short to medium periods. The banker therefore lends his funds for short period and for working capital purposes. Principle of profitability. Banks are profit earning institutions. They lend their funds to earn income, out of which they pay interest to depositors, incur operational expenses, and earn profit for distribution to owners. However, they do not have to sacrifice safety or liquidity for the sake of higher profitability. Means The first two principles of safety and principle of liquidity, they are more important as compared to the principle of profitability. Style of bank credit. Commercial banks provide finance for working capital purposes through a variety of methods. The main system or style of credit prevalent in India are depicted in the following diagram. Bank credit, two parts, loans and advances, and discounting of bills. We will discuss just after all these styles. Loans and advances are divided into three parts: overdraft, cash credit, and loans. Loans means short term loans, personal loans, medium and long term loans, bridge loans, composite loans, others which include credit cards, education loan, housing loans, etc. Or you may also say that they are part of even personal loans. Now we are discussing them one by one. Overdrafts. This facility is allowed to the current account holders for a short period. Under this facility, the current account holder is permitted by the banker to draw from his account more than what stands to his credit. The excess amount drawn by him is deemed as an advance taken from the bank. Interest on the exact amount overdrawn by the account holder is charged for the period of actual utilization. The banker may grant such an advance either on the basis of collateral security or on the personal security of the borrower. Cash credit system. Cash credit accounts for the major portion of bank credit in India. The salient features of this system are as follows. Under this system, the banker prescribes a limit called the cash credit limit, up to which the customer borrower is permitted to borrow against the security of tangible assets or guarantees. The banker fixes the cash credit limit after considering various aspects of the working of the borrowing concern, that is production, sales, inventory levels, past utilization of such limit, etc. The borrower is permitted to withdraw from his cash credit account amount as and when he needs them. Surplus funds with him are allowed to be deposited with the banker anytime. As the borrower withdraws from cash credit account, he is required to provide security of tangible assets. When the borrower repays the borrowed amount in full or in part, security is released to him in the same proportion in which the amount is refunded. The banker charges interest on the actual amount utilized by him and for the actual period of utilization. Though the advance made under cash credit system is repayable on demand and there is no specific date of repayment. In practice, the advance is rolled over a period of time. That is, the debit balance is hardly fully wiped out and the loan continues from one period to another. Or you may say that this is a continuous source of working capital requirement of the business. Under this system, the banker keeps an adequate cash balance to meet the demand of his customer as and when it arises. But interest is charged on the actual amount of loan availed of. Thus, to neutralize the loss caused to the banker, the banker imposes a commitment charge at a normal rate of 1% or so on the unutilized portion of the cash credit limit. Now, loan. Under the loan system, a definite amount is lent at a time for a specific period and a definite purpose. It is withdrawn by the borrower once and interest is payable for the entire period for which it is granted. It may be repayable in installments or in lump sum. Loans, according to their time limit, may be short-term loans and medium and long-term loans. Short-term loans are granted by banks to meet the working capital requirements of the borrowers. Such loans are usually granted for a period up to 1 year and are secured by the tangible, movable assets of the borrowers like goods and commodities, shares, debentures, etc. Such goods and securities are pledged or hypothecated with the banker. Medium and long-term loans. Such loans are generally called term loans. Term loans are granted for medium and long terms, generally above 3 years and are meant for purchase of capital assets, for the establishment of new units, and for expansion or diversification of an existing unit. At the time of setting up of a new industrial unit, term loans constitute a part of the project, finance which the entrepreneurs are required to raise from different sources. These loans are usually secured by the tangible assets like land, building, plant and machinery, etc. Bridge loans. Bridge loans, also called swing loans, interim funding, gap financing. Actually, in fact, they are short-term loans which are granted to industrial undertakings to enable them to meet their urgent and essential needs. Such loans are granted under the following circumstances. When a term loan has been sanctioned by banks and or financial institution, but its actual disbursement will take time as necessary formalities are yet to be completed. When the company is taking necessary steps to raise the funds from the capital market by issue of equities or debt instruments. Or you may say that bridge loans are allowed only for very short period, up to the time when the business will be in a position to arrange its source of capital. Composite loans. Composite loans are those loans which are granted for both investment in capital assets as well as for working capital purposes. Such loans are usually granted to small borrowers such as artisans, farmers, small scale industries, etc. Cluster financing. Cluster based financing is devised by the banks to provide a full service approach to cater to the diverse needs of small borrowers. This approach is said to help in dealing with well defined and recognized groups, information risk management, feedback mechanism, cost reduction. The Government of India has been advising banks to adopt at least one cluster on each district. Personal loans. These loans are granted by banks to individuals to purchase consumer durable goods. Personal loans are also granted for purchase, construction of houses. Classification of advances according to security. Three types: secured by tangible assets, covered by bank government guarantees, and unsecured. Secured advances. According to Banking Regulation Act 1949, a secured loan or advance means a loan or advance made on the security of assets, the market value of which is not any time less than the amount of such loan or advances. The amount of loan or advances includes interest on it. Guaranteed advances. The banker often safeguards his interest by asking the borrower to provide a guarantee by a third party, maybe an individual, a bank, or government. A guaranteed advance is in fact also an unsecured advance, that is, without any specific charge being created on any assets in favor of bankers. Unsecured advances. Unsecured advances are granted without asking the borrower to create a charge on his assets in favor of the banker. In such cases, the security happens to be personal obligation of the borrower regarding repayment of the loan. Such loans are granted to parties enjoying high reputation and sound financial position. Modes of creating charge over assets. As we have noted above, in case of secured advances, a charge is created over an asset of the borrower in favor of the lender. By creation of charge, it is meant that the banker gets certain rights in the tangible assets of the borrower. The borrower still remains the owner of the asset, but the banker gets the right of realizing his dues out of the sale proceeds of the assets. Thus, banker's interest is safeguarded. There are several methods of creating charge over the borrower's assets. Modes of creating charge are pledge, hypothecation, mortgage, lien, assignment. Now we will discuss them one by one. Pledge. Pledge is the most popular method of creating charge over the movable assets. Bailment of goods is the essence of a pledge. When the borrower pledges his goods with the banker, he delivers the goods to the banker to be retained by him as security for the amount of loan. Delivery of goods may be either physical delivery or constructive or symbolic delivery. Constructive or symbolic delivery does not involve physical delivery of the goods. The handing over the keys of the godown where the goods are stored, or even handing over the documents of the title to goods like warehouse receipts duly endorsed in favor of the banker amounts to constructive delivery. It is also essential that the banker must return the same goods to the borrower after he repays the amount of loan along with his interest and other charges. Hypothecation. Hypothecation is another method of creating charge over the movable assets of the borrower. It is preferred in circumstances in which transfer of possession over such assets is either inconvenient or is impracticable. For example, if the borrower wants to borrow on the security of raw materials or goods in process, which are to be converted into finished products, transfer of possession is not possible or not practicable because his business will be impeded in case of funds transfer. Then hypothecation is done. Under hypothecation, neither ownership nor possession over the assets is transferred to the creditor. Only an equitable charge is created in favor of the banker. The asset remains in the possession of the borrower, who promises to give possession thereof to the banker whenever the latter requires him to do so. Mortgage. A charge on immovable property. like land and building, is created by means of a mortgage. The owner transfers some of the rights of ownership to the mortgagee and retains the remaining with himself. The object of transfer of interest in the property must be to secure a loan or to ensure the performance of an engagement which results in monetary obligation. It is not necessary that actual possession of the property be passed on to the mortgagee. The mortgagee, however, gets the right to recover the amount of the loan out of the sale proceeds of the mortgaged property. The mortgagor gets back the interest in the mortgaged property on repayment of the amount of loan along with interest and other charges. Kinds of mortgage. Legal mortgage. The mortgager transfer legal title to the property in favor of the mortgagee by executing the mortgage deed. Equitable mortgage. The mortgagor hands over the documents of title to the property to the mortgagee and thus creates an equitable interest of the mortgagee in the mortgaged property. The legal title to the property is not passed on to the mortgagee, but the mortgagor undertakes through a memorandum of deposit to execute a legal mortgage in case he fails to pay the mortgaged money. Assignment. The borrower may provide security to the banker by assigning any of his rights, properties, or debts to the banker. A borrower may assign to the banker the book debts, money due from a government department or semi-government organization, or life insurance policy. This assignment may be either a legal assignment or an equitable assignment. In case of legal assignment, there is absolute transfer of actionable claim, which must be in writing. The debtor of the assigner is informed about the assignment. In the absence of the above, the assignment is called equitable assignment. Lien. The Indian Contract Act confers upon the banker the right of general lien. The banker is empowered to retain all securities of the customer in respect of the general balance due from him. The banker gets the right to retain the securities handed over to him in his capacity as a banker till his dues are paid by the borrower. It is deemed as implied pledge. Now, secured advances. Secured advances account for significant portion of total advances granted by banks. Banks grant advances against a variety of assets as shown below. Goods and commodities, documents which may include Documents of title to goods, stock exchange securities, life insurance policies, fixed deposit receipts. Other form of securities may be real estate, book debts, supply bills. First, we discuss the general principle of secured advances. Marketability of securities, adequacy of margin, documentation, agreement of pledge. Documentation means agreement of pledge, mortgage deed, promissory notes, etc. Goods and commodities. Bulk of advances granted by banks are secured by goods and commodities, raw materials and finished goods, etc., which constitute the stock in trade of business houses. However, agricultural commodities are likely to deteriorate in quality over a period of time. Hence, banks grant short-term loans only against such commodities. The problem of valuation of stock placed with the bank is not a difficult one, as daily quotations are easily available. Banker usually prefers those commodities which have a steady demand and a wider market. Such goods are required to be insured against fire and other risks. Such goods, either pledged or hypothecated to the banker, are released to the borrower in proportion to the amount of loan repaid. Documents of title to goods. These documents represent actual goods in the possession of some other person. Hence, they are proof of possession or control over the goods. For example, warehouse receipts, railway receipts, bill of lading, etc., are documents of the title to goods. When the owner of goods represented by these documents wants to take a loan from the banker, he endorses such documents in favor of the banker and delivers them to him. The banker is thus entitled to receive the delivery of such goods if the advance is not repaid. Stock exchange securities. Stock exchange securities comprise of the securities issued by the central and state governments, semi-government organizations, shares and debentures of companies, units of the mutual funds listed on the stock exchanges. The government securities are accepted by banks because of their easy liquidity, stability in prices, regular accrual of income, and easy transferability. In case of corporate securities, banks prefer debenture of companies vis-a-vis shares because the debenture holder generally happens to be secured creditors. Life insurance policies. The life insurance policy can be legally assigned to the banker, and the assignment may be registered in the books of the insurance company. Banks prefer endowment policies as compared to the whole life policies and insist that the premium is paid regularly by the insured. Fixed deposit receipts. A fixed deposit receipt issued by the same bank is the safest security for granting an advance. Real estate. Real estate, that is immovable property like land and building, are generally not regarded suitable security for granting loans for working capital. It is difficult, rather you may say very difficult, to ascertain that the legal title of the owner is free from any encumbrance. Moreover, their valuation is a difficult task, and they are not readily realizable assets. Preparation of mortgage deed and its registration takes time and is expensive also. Real estates are therefore taken as security for term loans only. Book debts. Sometimes the debts which the borrower has to realize from his debtors are assigned to the banker in order to secure a loan taken from the banker. Supply bills. Banks also grant advance on the security of supply bills. These bills are offered as security by persons who supply goods, articles, or materials to various government departments, semi-government bodies and companies, and by the contractors who undertake government contract work. Purchase and discounting of bills. Purchase and discounting of bills of exchange is another way banks provide credit to business entities. Bills of exchange and promissory notes are negotiable instruments which arise out of commercial transactions both in inland trade and foreign trade, and enable the debtors to discharge their obligations towards their creditors. Procedure for discounting of bills. When the seller of the goods draws a bills of exchange on the buyer, he has two options to deal with the bill. Number one, to send the bill to a bank for collection, or number two, to sell it to or discount it with a bank. When the bill is sent to the bank for collection, the banker acts as the agent of the drawer and makes its payment to him only on the realization of the bill from the drawer. The business of purchasing and discounting of bills differs from that of collection of bill. In case of purchase, discounting of bills, the bank credits the amount of the bill to the drawer's account before its actual realization from the drawer. The banker thus lends his own funds to the drawer of the bill. Bills purchased or discounted are therefore shown under the head Loans and Advances in the balance sheet of a bank. Advantage of discounting of bills. A banker derives the following advantages by discounting the bills of exchange. Safety of funds lent. As the bill has been drawn on some business, that business is responsible for the payment of the bills. Therefore, to a certain extent, the funds lent by the bank are secure. Certainty of payment. The period for which the bill is drawn. After that, the payment will be made. Therefore, it is almost certain that the payment will be done on the time. Third advantage is facility of rediscounting of bills. The bank is in a position to rediscount the bills with some other bank and may get the amount which has been advanced at any time. Stability in the value of bills. It is not related to the market conditions as in case of security of goods, etc. And therefore, there is stability in the value of bills. Profitability means here it is almost certain that the bank will get profits from this type of advances. Derivative usage promissory notes. To simplify the procedure of rediscounting, Reserve Bank of India has dispensed with the necessity of physical lodgement of the discounted bills. Instead, banks are permitted on the basis of such discounted bills to prepare derivative usage promissory notes for suitable amounts like rupees 5 lakhs or rupees 10 lakhs and for suitable maturities like 60 days or 90. These derivative usage promissory notes are rediscounted with the rediscounting bank or institution. The essential condition is that the derivative promissory note should be backed by unencumbered bills of exchange of at least equal value till the date of maturity. Bank also extend loans on the security of capital market instruments, which may include equity, debt instruments, mutual fund investments, venture capital investments, etc. Based on this, the RBI has formulated certain guidelines permitting banks to expose themselves to the capital market by way of advancing loans on these instruments. While the guidelines are indicative and suggestive, banks following robust risk management practices can approach Reserve Bank of India requesting for relaxation in the guidelines. Consortium advances. Credit needs of large borrowers may be met by banks in any of the following ways. By sole bank, only one bank. by multiple banks, but separately, on consortium basis, on syndication basis. In case of consortium basis and syndication basis, there a number of banks are involved. Sole banking, lending by a single bank to a large borrower, subject to the resources available with it and limited to the exposure limits imposed by the Reserve Bank of India. When the credit requirements of a borrower are beyond the capacity of a single bank, the borrower may resort to multiple banking, that is, borrowing from a number of banks simultaneously and independent of each other, under separate loan agreements with each of them. Securities are charged to them separately. Consortium lending, also called joint financing or participation financing, is also undertaken by a number of banks but against a common security which remains charged to all the banks for the total advance. Usually, in case of consortium lending, one of the banks acts as a consortium leader and takes a leading part in the processing of the loan proposal, its documentation, recovery, etc. The participating banks enter into an agreement setting out the terms and conditions of such participation arrangement. Reserve Bank directives. As per the directives of the Reserve Bank of India, whenever a consortium is formed, either on a voluntary basis or on obligatory basis, the ground rules of the consortium arrangement would be framed by the participating banks in the consortium. These rules may relate to the following: number of participating banks, means how many or the number of banks which are participating in the consortium at once. Minimum share of each bank, means how much percentage will be advanced by each bank. The minimum share. The advance may be more than that, but the minimum must be, and the total of minimum must be equal to 100%. Entry to exit from a consortium. Sanction of additional or ad hoc limit in emergency situation or contingencies by lead bank or other banks. The fee to be charged by the lead bank for the services rendered by it. Grant of any facility to the borrower by a non-member bank. Deciding time frame for sanctions renewals. Syndication of credit. The salient features of a syndicated credit are as follows. It is an agreement between two or more banks to provide a borrower a credit facility using common loan documentation. The prospective borrower gives a mandate to a bank, commonly referred to as lead manager, to arrange credit on his behalf. The mandated bank prepares an information memorandum about the borrower in consultation with the latter and distributes the same amongst the prospective lenders, inviting them to participate in the credit. On the basis of the information memorandum, each bank makes its own independent economic and financial evaluation of the borrower. It may collect additional information from other sources also. Thereafter, a meeting of the participating banks is convened by the mandated bank to discuss the syndication strategies relating to coordination, communication, and control within the syndication process, and to finalize the deal timings, charges for management, cost of credit, share of each participating bank in the credit, etc. A loan agreement is signed by all the participating banks. The borrower is required to give prior notice to the lead manager or his agent for drawing the loan amount so that the latter may tie up disbursement with the other lending banks. Under the system, the borrower has the freedom in terms of competitive pricing. Non-fund based facilities. Banks also provide non-fund based facilities to the customer. Such facilities include letters of credit and bank guarantees. Under these facilities, banks do not immediately provide credit to the customer, but take upon themselves the liability to make payment in case the borrower defaults in making payment or performing the promise undertaken by him. Letter of credit. A letter of credit is a written undertaking given by a bank on behalf of its customer, who is a buyer, to the seller of goods, promising to pay a certain sum of money provided the seller complies with the terms and conditions given in the letter of credit. Bank guarantee. Banks issue guarantees to third parties on behalf of their customers. These guarantees are classified into either financial guarantee or performance guarantee. In case of financial guarantee, the banker guarantees the repayment of money on default by the customer or the payment of money when the customer purchases the capital goods on deferred payment basis. A bank guarantee which guarantees the satisfactory performance of an act, say completion of a construction work undertaken by the customer, failing which the bank will make good the loss suffered by the beneficiary, is known as performance guarantee. Credit worthiness of borrowers. The business of granting advances is a risky one. It is more risky, especially in case of unsecured advances. The banker has to investigate into the borrower's ability to pay as well as his willingness to pay the debt taken. Such an exercise is called credit investigation. Its aim is to determine the amount for which a person is considered credit worthy. Credit worthiness is judged by banker on the basis of three C's of the borrowers. These C's are character, capacity, and capital. Determination of creditworthiness of a borrower has become now a more scientific exercise. Special institutions like rating companies such as CRISIL, ICRA, CARE have come on to the field, and each of them has developed a methodology of its own. Other sources of short-term finance: raising short-term and medium-term debt by inviting and accepting deposits from the investing public has become an established practice with a large number of companies, both in the private and public sector. This is the outcome of the process of disintermediation that is taking place in Indian economy. Similarly, issuance of CP, commercial paper, by high net worth corporates enables them to raise short term funds directly from the investors at cheaper rates as compared to bank credit. In practice, however, commercial banks have been the major investors in CP in India. Factoring of receivables is a relatively new innovation which enables the corporates to convert their receivables into liquidity within a short period of time. Public deposits. Public deposits are unsecured deposits accepted by companies for specific periods and at specific rates of interest. There have been stringent restrictions in accepting deposits from the public now. The following are the pertinent aspects related to this issue. No company shall invite or accept deposits from public unless the company meets a specific criteria. As at present, a public company having net worth of rupees 100 crore or turnover of not less than rupees 500 crore will only be eligible to accept deposits from public. The public company shall obtain credit rating every year from a rating agency and publish it properly. It shall create a charge on the assets equal to the amount of issue. All other companies can accept deposits only from their members. The Ministry of Corporate Affairs, through the notification dated 31st March 2014, issued companies acceptance of deposits rule incorporating rules on the following: terms and conditions of acceptance of deposit by companies, form and particulars of advertisement or circulars, manner and extent of deposit insurance, creation of security, appointment of trustee for depositors and their duties, meeting of depositors, form of application for deposits, maintenance of liquid assets and creation of deposit repayment reserve account, and register of deposits. Advertisement. Every company intending to invite or accept deposits from the public must issue an advertisement for that purpose in a leading English newspaper and in one vernacular newspaper circulating the state in which the registered office of the company is situated. The advertisement must be issued on the authority and in the name of the board of directors of the company. The advertisement must contain the condition subject to which deposits shall be accepted by the company and the date on which the board of directors has approved the text of the advertisement. In addition, the advertisement must contain the information regarding company and its management. Information regarding financial position, profits and dividend, details regarding deposit and statutory declaration. Before issuing an advertisement, a copy of such advertisement shall have to be delivered to the registrar for registration. Such advertisement should be signed by the majority of the directors or their duly authorized agents. That's all. Thank you.